Thank you for joining us. The slides are loading. Chaz, can you see my screen?
Yes.
Okay, good. Thank you. Welcome, everybody. Thank you for joining us today. I'm really excited to share this content with you. It's one of my favorite topics. I am Kelly Olczak, if you don't know. I am the managing partner of Lindley and Company. We manage a handful of families' finances in the area. I'm really proud to say that we're 100% woman owned. We're a registered investment advisor located in the Bushnells Basin. We are a fiduciary. It's my second favorite F word. My first one is fun. Joining us today, we've got Chaz Miller, who is our operations manager, and my partner, Becky Gillette, who is our chief compliance officer. And Chaz, you did say that you can see the slide deck, correct?
Yes, I can.
I'm notorious in getting 5 minutes into this conversation and forgetting that part. So anyhow, Chaz is going to be our moderator today. We've got a couple polling questions that she's going to help us with, but also feel free to use the chat function. Our friend Earl has already started by teasing me, saying that no one can shut me up, which is adorable. I will talk to you later, Earl. Thank you. One of the best things we do, I believe, is educate our clients. We like to help them become better, more informed, educated investors. And this is a topic that really has always come up in questions during financial planning. So the first thing we're going to do is start with our first polling question, just to kind of get a baseline on where everybody is. Chaz, can you just push that out for us? Thank you. Thank you. Make sure you post the answer so people can see it. Thank you.
I'm going to end that because everybody answered. Thank you so much.
That's fantastic.
And then I'm going to share the results.
Great. This is the third monthly webinar we've done, and we're trying to do this consistently, and we are learning how to do this well. There are lots of new tools on Zoom, so if we're a little rough around the edges, that's okay. We're going to get better. So thank you for that, Chaz. That's awesome.
Yes.
Okay, so thank you for participating. That's super huge. I'm a certified financial planner, and our practice has always specialized in helping people maximize their social security benefits and then coordinate their other retirement resources to reduce taxes and ensure adequate income during retirement. And like I said before, this is one of my favorite topics. There's a lot of information we're going to cover, so you may come up with something that's really important to you. And if you want to cover this one-on-one, and please let me know. We'd be happy to help you after today. Okay. But when your parents retired, they probably didn't think too much about Social Security and their benefit. They probably just went down to their local office as soon as they turned as early as 62 at one point. Now at the earliest is 65, but now you can go into 62. And they applied for their benefits. Maybe they took their benefit a little for granted because they didn't really know that they could ask questions to the folks that were, helping them get their benefit. Today is very, very different. Baby boomers are approaching this in a very, very different way. And I'm really happy to kind of cover some of this stuff. Social Security and Medicare have been in the news quite a bit, and it should not be trivialized. It is a benefit that we've paid into. What I'm trying to hope for is to give you some clarity to help you understand what might be important to you. Okay, so first thing we're going to, there you go. like I said, not the first time I've done this, but certainly that's awesome. Um, so the first thing we're going to do is kind of explain to you what your benefit is and how to understand what you might get if you when you turn things on. So Social Security is one of those types of income you can't outlive. A lot of people are worried, especially now with rising interest rates. They're worried about running out of money. Planning for Social Security is super important when to turn it on, but it's one of those benefits that continues until you die. And of course, if you live longer, you get more money. This slide kind of covers if your benefit was $2,000 today, what your lifetime benefit would be. It's pretty kind of cool. In this slide, we're assuming a 2% interest rate cost of living adjustment. We're going to cover a little bit more about that. But I mean, for 10 years, you're getting $2,000 monthly benefit with interest added to it for inflation. $263,000 is not too bad for 10 years. Certainly, I would like 30 years. So there is an annual inflation rate adjustment. That's called COLA, COLA, cost of living adjustment. So in this slide, if your benefit was $2,000 and you had a cost of living adjustment at 2%, in 10 years, in 10 years, your monthly benefit would be $2,438. In 30 years, it'd be $3,623. Now, last year, the cost of living adjustment, COLA, was an increase of 8.7%. The prior year, it was 6.2. So the official cost of living adjustment every year comes out in October. So we don't know what that's going to be next year, but around October, there will be an announcement stating what the new adjustment will be. And of course, there's no way to know exactly what that adjustment's going to be. So when we do our planning, I'm the most optimistic person I know until I do financial planning. Then I'm really pessimistic. So I use a reasonable estimate of 1.5% because shockingly, my crystal ball doesn't work. Okay, so when your Social Security benefit is calculated, it's based on how much you've earned over your career, and it's also based on when you turn your benefit on. So some of you may get your Social Security statements from the SSA, Social Security Administration. If you are younger than 62 and you get your statement, your numbers, which I'm going to show you a sample in a minute, your numbers are estimated. But as soon as you hit 62, those numbers are real. Okay, so here we go. How do you calculate the formula? Okay, so I do have engineers in this audience, and I have some non-engineers in this audience. So you may want to understand how your number is calculated, but I think it's kind of interesting, and I think it's important for folks to know. So in general, here's how it works. The first thing they do, the SSA looks at, are your annual earnings over your lifetime. I thought it was very fascinating when I got my first statement because it went all the way back to like 1983. I think I earned $289 I had to pay taxes on. So on my statement, what happens is they index my earnings in 1983 and adjust it for inflation. Okay. So even though you're looking at your statement and say, oh, I earned, these little tiny dollars, they bring it up to today's dollars. Then what they do is they take the 35 highest years earnings to include it in this formula. Some of our families have moms like mine who stayed at home. And so my mom didn't have any earnings on her Social Security record. She relied on my dad for that. But I have other families that mom stayed home while she was raising the kids and then went back to work. So those years would have been zero. Okay. So if you have zeros in there, they are still included in that 35-year average. The next thing they do, the formula takes what's called your average indexed monthly earnings, AIME. We'll come back to that. They take your average indexed monthly earnings to determine your primary insurance amount, PIA, not pain in the PIA, primary insurance amount. That is the amount that you would receive, the PIA, if you took your Social Security at your full retirement age, FRA. Isn't this fun? Yes. Anyhow, each year, annual cost of living adjustments are applied to your benefit to help you keep up with cost of living. Okay. Are there any questions so far? Because I know some of this is easy to get and some of it is a little ticklish. And if you do have questions throughout this conversation, feel free to add it to the chat function. Chaz will stop me as soon as we hear that you've got a question. Okay, so here's the math. So what this shows you is an example of how the benefit formula would apply for a baby boomer who was born in 1961 and who earned the Social Security maximum every year since the age of 22. So this person's average indexed monthly earning would work out to $12,427. In calculating this primary insurance amount, that's the PIA, the first $1,115 would be multiplied by 90%. Then the amount between $1,115 and $1,621, if you do the math, that's $5,606, is multiplied by 32%. And the amount over $7,621 or $5,706 is multiplied by 15%. These amounts would be totaled up to come up with a PIA, primary insurance amount, of $3,653.35. That is the amount this worker would receive at their full retirement age. Okay, I know this is complicated. Fortunately, you don't have to do this by yourself, but I think it's important for people to know how these things are calculated, because we'll learn later, if your earnings record is not correct, that's the only thing you can update. So these numbers do matter. Okay, so what is full retirement age? Depending on where you were born, when you were born, your full retirement age, also called FRA, could be anywhere between 66 years old and 67. It used to be 65, but now we're seeing higher full retirement age being around the result of 1983 amendments. So there's been some tax changes, which changed it from 65 to this slide that we're seeing. So those folks that are born between 1955 and 1959, you've got 66 years and months. But for those of us that were born after 1960, it's just simply 67 years old. So that's your FRA. So if you've seen a recent Social Security statement, it has changed. And I really do like this because it's more graphical on the impact of when you choose. So in this example, what you see is your full retirement age. If your full retirement age is 67, your monthly amount would be $2,119. Okay, we're going to come back to this, but I do like to teach with visuals because you probably remember the pictures before you remember the words. Okay, so remember that I said your primary insurance amount, or PIA, is the benefit you will receive at your full retirement age. So what happens if you apply before your full retirement age? You are still eligible for benefits, but your amount will be reduced. So if your full retirement age is 66 in a couple months, or 2 months or whatever, it's reduced as much as 75%. If you were born after 1960, your full retirement age, your FRA, is 67. And so your benefit could be reduced as much as 70%. Okay. Now, I do recognize that we're covering a lot of math. This presentation will be on our website. You will be able to come back to it. So you can kind of remind yourself of what you saw if there's something that pops up. But again, feel free to ask us questions. Okay, so what if you apply after your full retirement age? So what's neat about this is that if you delay, you have as much as an 8% guaranteed return, meaning your benefit will increase by 8% every year you delay. Okay, not for nothing. I don't have anything that guarantees me 8% return, so it's not too bad. So if your full retirement is 66 and you apply at age 67, you'll get 108% of your PIA, that primary investment amount or insurance amount. If you at 68, it would be 116%, and so on. Okay. Then if you're 67, the math's just a little different, but still it's not too shabby. And again, remember, these are benefits that will not outlive you. So going back to the sample Social Security statement, if you were 67 and your full retirement amount was 2119 and you wait until you're 70, your monthly amount is 2634, which is a lot better, not too shabby. I'm pretty sure that no one really wants to calculate your average index monthly earnings, or your AIM, and then reduce and add credits and all that fun stuff, blah, blah, blah. So this is a slide that will help you figure out how to get these real numbers for yourself. Now, the thing is that if you're not 62, again, I'm going to repeat this. If you're not 62, your statement is important, but it's not perfect because they don't really nail it down until you're 62. But these websites are really super helpful. It used to be many years ago, you would get statements mailed to you, hard copy. They stopped doing that. They completely for a while. I think that was around 06, 07. And then, the financial crisis happened. And so, yeah, they didn't mail anything out. But now they're starting to do it again. But you can log into socialsecurity.gov/my-account. You can create your own account. It's a little ticklish, but it is super, super secure. So make sure you take notes. So they're going to ask you to create, a secure login. They're going to ask you what your mom's maiden name is, your social security, but really it is slightly brutal, but certainly secure. There are retirement estimators on there, which work if you were, which are helpful if you're younger than 62, because your statement is not perfectly polished. Okay. And then there is a benefits calculator on there, which is kind of neat. The thing I want you to remember, though, is that the annual statements and before you're 62. Well, no, actually, I have to pull that back. Your annual statement and the retirement estimator do not include your cost of living adjustment. Okay, so that happens every year. So when you get your statement, when you use these calculators, be mindful of that. One thing to know, though, it will help you get a ballpark for planning. And your benefit will definitely be higher than what they are indicating when you get your feed out. Okay. Okay. Holy cow. That was a lot of information. Are there any questions? Okay.
Not so
So
far, Cal, sorry.
that's okay. That's okay. I'm smart enough to know that now I can see the chat function in one of my little windows over here. So thanks for that, Chaz. So now let's kind of shift a little bit to the decision of when to apply for benefits, which is super important. And there are some complicated things that can go in to this decision. So we're gonna literally, it can literally make a difference of thousands of dollars over your lifetime. So we're just gonna walk through this a little bit. And before we start getting into crunching numbers, it's important to realize that everybody's situation is different. And if you are, we're going to talk about some examples of a married couple, but I want you to think about this. If you're a divorcee, if you're single, if you're a surviving spouse, we definitely focus on this too. But today we're just going to talk about um, a married couple. And please know that we're not being insensitive. It's just I couldn't figure out where to start. So I figured I'd start here. Okay, so now, Chaz, I'd like you to send that second poll out, please. Thank you.
I'm gonna end that now and share.
Yay. Well, that's called Kelly's Job Security Act right there. So, when so Becky and I started at Edward Jones in 2005. And Becky had spent 10 years at Merrill Lynch, and we started about 3 months apart. The neatest part about being at Edward Jones, they allowed each advisor to polish their practice and, specialize. And hands down, the time I've spent learning Social Security has benefited our clients and our prospective clients tremendously. It is complicated. So I know that getting started is tough. And so that's why we're doing this. Any feedback you guys could give us after this on areas that we don't cover you'd like to know about, please tell us more, because we don't know what it's like to be a client anymore, okay? All right, so let's move forward. The when to apply question is something that complicates it. So it's very complex and it does require specialization because everybody's different. But here are a couple of things to remember. If you apply early, your benefit is reduced forever, right? Whatever your date that you decide to turn it on, that's your amount. It, of course, will grow with the cost of living adjustment, but it does not go up above the day that you turned on. If you applied and took your income early, right? So you're getting anywhere between a 75 and 80% reduction in your income for the rest of your life. Now, that being said, if you need the income, you need to take the income. So don't let that freak you out. But if you don't need the income because maybe you have other savings, that's where it can get a little complicated. And we're really good at helping people with that. Now, the cost of living adjustment will magnify the impact of early or delayed retirement because that annual cost of living adjustment is applied to both, whether it's the lower amount or the higher amount. And that disparity gets bigger. Okay. So the other thing to think about if you are married, or even divorced. It impacts your survivor, whether were married when you died, or if you were divorced. It does impact the survivor benefit. So we really encourage our clients, if they can afford to, wait until you're 70, because that does allow the surviving spouse a higher benefit after the deceased spouse passes. I do recognize that there's some politics in the Social Security Administration trust. But for those people that are, 62, even 58, I'm not worried about the trust. I think it's going to change. It has to change for our children. So we're going to suspend that conversation for now. I've got another presentation if you want to know about it around the health of the trust, but just bear with me on this, okay? Anyhow, let's move forward. So I'm going to show you a handful of strategies to maximize your benefit, okay? And so the first thing we're going to do is look at improving your earnings record. So at the beginning of this presentation, we talked about how your earnings are calculated, right? So we're going to talk about, is your earnings record accurate? Are there any missing years? And can you improve by working longer? Okay. So I'm going to bring this guy up again. This is the second page of your new Social Security statement. Okay. It's really cool because it goes back to when you were a baby, your average income was $2,142. So what happens is, if you check your earnings record, now mind you, mistakes are rare. Earnings are kept on file at the SSA. Your employer sends a W-2 in, and the SSA knows about that. Social Security Administration is the SSA. So they keep track of that. But if you're self-employed, those earnings are reported on your tax return. They don't get a W-2. So if you find an error, you can correct it, okay? The next thing to think about is improving your record. So for our clients who stayed home for 6, 7 years raising kids, they have 6, 7 years of zeros. Those go into that 35-year highest earnings average that calculate your AIME, right? If you've had a number of years where you're low earnings in your career, I've got a client who was a graduate at a college, university, and had 4 years of, very low earnings in mid-20s. By working a couple years more, those low earnings fall off, okay? Even if you start research, sorry, this is what happens when I talk too much. Okay, so some people may start taking their Social Security early. You have to also consider the income you get in those years. Okay, so if let's say you took Social Security at 62 and you made more than $21,240. So every year there's an earning limit. So if you earned more, so let's say you earned $30,000, you took your Social Security at 62, they will not pay attention to the first $21,240. That number changes every couple of years. So that's this year, $21,240. For every dollar in benefit, so if you earn, for every $2 you earn, they're going to take $1 away. Sometimes it makes sense to do it anyhow, and sometimes it doesn't. That reduction, we're going to cover this a little bit more, but that reduction only happens until you're hitting your full retirement age. Okay. Strategy 2, applying at the best time. So we've we really try and make the case to delay benefits as long as you can. Because again, it's a benefit that you won't outlive. And it's a benefit that your surviving spouse can benefit from. And again, there's no one size fits all. So let's look at something. We've got some really neat tools here that help our clients visualize what their decision makes. So we're going to walk through one of those. And we have invested an awful lot of time. Like I know that Chaz, Becky, Jason, Miles are sick and tired of me saying, oh my God, I found this really neat thing about Social Security, but it really matters. Okay. So there are a lot of nuances to when to take your benefit, but I'm going to show you an example because again, I think that pictures will sit with you longer than the words. So here we go. So here's a family, Bob and Linda. Bob is 64, Linda is 57. Bob is a small business owner and he plans to work past 70. Linda is a special ed teacher and wants to retire as soon as possible. They want to know when to turn it on. So this really neat tool that I use helps them look at 5 different things, right? So you'll see at the top left-hand corner, Bob claims at 64 and Linda claims at 62. I'm sorry, Bob is 60. Yeah, okay, got it. Sorry. Make sure my data is right. So the upper left-hand corner is they both take the benefit as soon as Linda retires. All right. And so this is all about making sure Linda, who's a lot younger, has as much benefit as possible. So at the very bottom of that scenario, you're going to see that if Bob were to die in 1947, her monthly benefit is $44.54. What we are trying to do is maximize the loss of one of a spouse's benefit because you're not going to get both. You're going to get the highest amount. So in this scenario, their lifetime nominal benefit is $22.2 million. Okay. Then we look at, Bob claims on his own record at his full retirement age, and Linda waits as well. Third one is they both wait. Fourth one is Bob claims later, Linda takes her benefit as soon as possible. And then lastly, maximum lifetime nominal benefit, which turns out kind of weird. I know it's weird, but Linda files at 69. You'll see later that they chose the fourth option. Okay, so the next thing this thing spits out is, what does it look like over a lifetime? Again, I like pictures and I like more money than less. And for those of you that are engineers in the group, yes, we do have a break-even comparison. And basically what that means is how long, because again, our crystal ball doesn't work. If we made this decision, how soon would we break even? And then lastly, here's the survivor benefit analysis, all super helpful. This applies to widows and divorcees also. We're just talking about couples right now. So we can do the same thing for folks that are divorced and folks that have unfortunately been widowed. So before I go any further, are there any questions about this stuff?
No questions yet.
All right, so we talked about this a little bit. I just want to review it. Again, because it's an important consideration, and that's whether to work or not work. So if you apply before you hit your full retirement age, and you earn more than $21,240 in 2023, $1 of benefit will be pulled away from you for every $2 you earn over $21,240. Okay, now here's something really neat. It's not really taken away from you, okay? It's rather your benefit will be adjusted upward when you do hit your full retirement age. This means that if some of your benefits are withheld because you're earning too much, your new benefit will be higher when you get older. Okay? Please don't let earnings tests worry you. Don't let it discourage you from working. It's not a penalty. Okay? They're not penalizing you for working. The adjustment is going to be made. You'll end up with a higher benefit for the rest of your life. And of course, the earnings themselves will contribute to your financial well-being because it's going to increase your, your earnings over time.
We do have a question, Cal.
Yeah.
Do capital gains count as earnings?
Thank you, Michael Rushlander. They do not. However, we'll talk a little bit later. Municipal bond interest from tax-free bonds do. Thank you. That's so important. And we're gonna cover a little bit more of that, but please bring those up. That's important. Thank you. All right, so this is a little bit of an overlap about the tool that we use. I do kind of like redundancy in this because we are covering a lot of information, but maximizing your benefit and coordinating with your spousal benefit is key. So the goal is to maximize your income for both of you while you're alive, and then maximize income should one of you pass away. This can be a little complicated, so please be patient with us, but understanding all the considerations and doing some calculations, it's possible to figure out what's best for you individually. Okay, so I did just pop up. See, Chaz, I'm learning. There's a question right now.
Great, I'm glad you.
So Mike, when are spousal benefits higher using their spousal benefits than if the spouses were to apply for benefits by themselves only? Okay, so that's where we can run that calculation to see. Everybody's different. And what I'll do is I'll go back here. Okay, so thank you, Mike, for this question. Our software starts with who is spouse one and what is their date of birth and what is their primary, their PIA, right? That's your full retirement age monthly amount. And then what is spouse two's date of birth and spouse two's PIA? We plug that in, okay? And so these scenarios, like for Bob and Linda, the inputs are based on them first. So I think, Mike, this might answer your question, but I know you and I have spoken before. So if you guys want to run through this separately for yourselves, I'm okay to do that with you so you can see what your personal numbers look like. But it really does start with what is, Kelly Olczak's benefit and what's Jean Olczak's benefit and when is their full retirement age. And then this tool will give you the kind of output I think you're looking for. Does that help, Mike? I'm going to assume it does. Okay. And I forgot which slide I was on before I went backwards. Hang on. Okay, good. All right, so maximizing benefits, and I forgot that this slide was next. So here's Bob and Linda's scenario outcomes. Now, Bob and Linda are real people. They are real clients, but we've changed their names. So, but the backstory is accurate. Bob wanted to retire early. He wanted to stop completely when Linda hit 62. But when he saw these scenarios, he was like, oh, that stinks. So they did choose scenario number 4, which is Linda stops working at 62. Bob's business is, it's a business, but it's not, he doesn't have employees, and he's got a handful of very happy families and customers that he works with, and working's not that hard. So it made more sense for strategy number 4 for them, because again, if Bob were to die before Linda, both social security numbers are changed. Linda will get the biggest number, which is this 6. Oh gosh, I hate it when I do that. I'm sorry. So Linda will keep her number, and the Social Security Administration will bump her number up to get her to 6882. There's still a loss there. So we're trying to make sure we get as much as possible. Okay. And again, I want to recommend that, I know we're talking about a married couple. This calculator that we have is fabulous for single people, divorcees, widows. And for divorcees and widows, there are different rules, okay? So feel free to reach out to us if you'd like to have us run this sort of thing for you. All right, so taxation. Mike Reschlander, thank you so much for asking this question. This is important. Social Security can be taxed at 0% or 85%. The middle number is 50%, and it depends on what kind of other income you have. But these are kind of ideas that are going to give you some baseline on what to think about. So I know there's no one on this earth that likes to pay taxes. And you can minimize taxes on your Social Security by lowering your other income, especially investment income. So Social Security and capital gains and municipal bond income are wrapped into that, but so let me step back. Capital gains, no, let me do this a different way. Bond income is taxed like earned income. So Mike Reschlander, I'm not sure I answered your question completely accurately, so please hold. But municipal bond, tax-free income from bonds does impact the taxability of your Social Security benefit. Okay? Capital gains is a separate category, but what we're trying to do is minimize the taxability of your benefit. And muni bonds, a lot of people don't realize, well, it's tax-free. Yes, it's tax-free income, but it does impact how much your Social Security benefit is taxable. Is that helpful? I hope so. So I'm rethinking, Mike Reschlander, what you asked me, and I'm going to come back to you on that, because I think I understand what your question was. But this municipal bond income is taxed differently than capital gains taxes. One is taxed like earned income, that's the municipal bond interest, and one is taxed like capital gains. Sorry. Sometimes okay, thank you, Mike. Mike said, understood, Roger, Roger. Thank you for bailing me out, Mike. Okay, now, some of you may have been part of our prior 2 months workshops. There have been some really cool changes around when required minimum distributions occur for different people. It used to be that when you turn 70 and a half, you would have to take your required minimum distribution from your IRA. Depending on your age now, it could be pushed back to 73 or as much as 75. but you still need to anticipate what that distribution looks like and how much it's going to affect your Social Security benefit. And there's this weird kind of donut hole between the 50% taxable Social Security and 85, which was in last month's workshop. And these are all on our website if you want to review them. So I might be getting a little propeller head on this, but if you're worried about how much your Social Security is going to be taxed, these are things that you have to pay attention to. Okay, so strategy 5, coordinating with your other investments. All right. So before we go to the next slide, Chaz, let's get that third survey out. And thank you everybody for participating. This has been fantastic. How are you doing, Chaz?
Good. I was just gonna give it a couple more seconds and then I will end it. And share.
Nice. Good.
So good mix of different folks with different plans.
Thank you so very much for participating, you guys. Really, really appreciate it. Okay, so moving forward. So pensions, IRAs, 401ks, the required minimum distribution you're going to need to take as early as, so some people are already taking their RMD. So we're talking to you folks that haven't started. So your date is probably 73. These, your overall investment portfolios, they work together. All these resources should be coordinated to make sure that, you don't outlive your money. Part of the reason I'm doing this webinar is because this Social Security planning tool we have has so affected how people decide to turn on their streams of income. Nobody wants to outlive their money. Retirement planning, well, I think it's easy, but I do it for a living. Timing it, when to convert things, when to turn them on. Social Security is certainly something that you won't outlive, but we need to coordinate when to turn those things on and when to wait. Okay. Thank you. We have covered a tremendous amount of information, but here's some things you guys need to consider. Obviously, when to turn it on. Do you want to keep working? What happens if you've already applied? Sometimes, if you've applied, certainly very recently, you may decide, oh, I didn't really want to turn it on, and I want to rewind. They do give you a little grace period where you could say oopsies and then turn it off and then turn it on later. Obviously, if you're married, you want to think about how to coordinate those benefits. Everybody's situation is different. So long-term is always important. I want everybody to live so happy in life and not ever run out of money, which is why I really do enjoy this presentation. And what do you do next? We are a very cool firm that helps people figure this stuff out. And I'm looking at our participants. A number of you are not our clients yet. And if you'd like to kick the tires with us, we'd be really, really happy to sit down with you at no cost to show you how we help our clients. We'd be happy to run a scenario for you. What's the worst thing to happen? You walk away with really good advice. I am a fiduciary. We are fiduciaries. Even if you never worked with us, we have to do what's right for you. So if you decide that this is something you'd like to do, please let me know. During that appointment, we can really get down to brass tacks around when to turn it on, whether you're married, single, divorced, widowed. Um, Lastly, I want you to know after this workshop, we're going to send you out 3 handouts. One is Social Security claiming under the new rules because they did just change. Okay. Social Security planning for couples, how to maximize your benefits, and understanding your Social Security benefit estimates. And that's because, reminder, if you're not 62 yet, your statement's not perfectly polished. Okay. We are going to have a workshop for folks that are divorced and widowed, because the planning is a little different. But in the meantime, if you want help if you're in either of those situations, we'd be happy to help. Okay. And that's it. We're very happy to present this information. We are going to produce a replay and post it on our website. Please let us know what we could be doing better or what we could be talking about that we're not touching on. Education is the best thing we do for our clients. We manage their finances, we build financial plans, but I've always wanted them to, we have always wanted our clients to become more educated so that um, they know what we're talking about. Anyhow, that's all I have for today. If there are any questions, boy, I'd love to hear them.
Thank you, everybody.